Welcome back for another report on the oil market. Crude oil prices saw limited action in the latest daily sessions. The commodities price rose to a new monthly high price briefly in the past week, surpassing $53.5 per barrel, yet relented some gains in the following sessions. However, due to the fact that crude oil's price remains very near to the monthly high at the moment, it could be a sign that traders have a more long-term plan in mind and are not ready to cut their oil positions. Looking into the weekly oil market data releases, we have the opportunity to see if the figures have influenced traders at all. On the 15th of January, we got the weekly Baker Hughes oil rig count that indicated active oil rigs rose to 287 from 275. An increase in oil rigs is always a bullish sign for investors, as the rigs are usually opened upon demand. Even though crude oil price moved lower on the specific day, the drop was performed before the release of the Baker Hughes figure, which may imply some take profits had occurred. On the other hand, on the 20th of January, we received the AP weekly crude oil stocks that indicated a surplus of 2.56 million barrels, which came as a surprise. Analyst expectations was for a minor drawdown of 0.3 million barrels, and the surplus was rather significant, missing forecast by a lot. Equally, crude oil's price headed lower and closed Wednesday with a move lower. However, as noted before, WTI's price has not made big moves lately, which could be an indication that the market expects the commodity to be more expensive in the short term. On a separate note, in the past days, the International Energy Agency monthly oil market report for January was released. This report tends to overview some of the current matters surrounding the global oil market and also makes future forecasts for the commodities price. According to the report, world oil demand is predicted to increase by 5.5 million barrels per day to a total of 96.6 million barrels per day in the current year. At the moment, a resurgence in COVID-19 cases and extended lockdown measures can be the main reasons holding demand lower. On the contrary, global vaccination is also taking place, countering the pre-mentioned obstacles to demand. Vaccination is expected to accelerate economic activity and support growth in the second half of the year. In our opinion, the amount of fiscal stimulus packages prepared by governments around the world could also stimulate crude oil prices, as they aim to revive economies that have been damaged by the pandemic. In the report, it was also mentioned that in spite of rising COVID-19 cases, crude prices are well supported by financial, economic and market fundamentals. Furthermore, higher crude prices could act as a reason to increase production in the US shale industry, which was severely damaged last year. For the time being, the oil market seems to show some improvement as per demand, but at the same time remains very fragile. The oil market depends greatly on how fast countries will be able to control and limit the spread of the virus. As a final note, US President Joe Biden and his administration are taking action to reduce carbon emissions and have announced America's return to the Paris Climate Accord, while at the same time withdrew a permit for the Keystone extra-large oil pipeline project from Canada. We do not expect the news to affect the commodities price for now, but rather in the far long term. Finally, traders should be aware that the weekly EIA crude oil stocks will be released tomorrow, the 22nd of January, and volatility could increase. Moving now to the technical analysis and WTI's 4-hour chart. WTI is currently just below our 153.50 resistance level during the latest 4-hour sessions. Yet the commodity has maintained its upward movement formed since the previous months, and as long as WTI trades above $50 per barrel, we keep a bullish outlook in place. Other levels we have noted in case of a continuation of the upward trend are the R256 line and the R358 barrier. In case of a correction lower, however, the commodity could first test the S1 5150 line. If the S1 is breached downwards, we may see the S2 4950 level coming into play, or even the S3 47.50 hurdle if the drop is strong enough. The RSI indicator is running across the 50 level for the time being, displaying further the stabilization of the commodities price and even implying some uncertainty among traders. We hope that you found this report useful, and if so, don't forget to share and subscribe. From all of us here at IronFX, best wishes for solid trading.